On today's show, we're talking about why we started to get defensive back on August 2nd. That's about 6% ago. The market's dropped about 6% since August 2nd, and we started to get defensive way back then. I want to share with you how and why and what mindsets, the different things that I was looking at when I was getting defensive at that point, all the different things that we share inside our programs and inside the book as well. Let's dive right into this. So, I'm going to share my screen and we will hop on in. As I'm switching gears over here, I want to say welcome to everybody that is hopping on and make sure that you like and subscribe wherever you're at and post comments as we go. We'll be answering a lot of questions here. All right, so take the annotations off for a moment. It, the market was rolling for a while, right? We're taking a look at the NASDAQ right here. So from May, the market ran up about almost 18% without stopping. Then we got into this little congestion area here. Not much different than this one back here, but on this day, right over here, market dropped 2.5, almost 3% on that day. And we shifted gears. We shifted gears on this day and started to roll things back. Since then, the market has fallen about 5.5%. So, how, why, well, what tipped us off? Well, there's a few things that tipped us off to this decline. And first, I do want to say too that it's not that that we predicted anything. It's that on this day, on this day back here, we started to get defensive, and then the market hasn't reasserted itself, so we've simply remained defensive. Now, what happened back then? First thing that happened, right? This is the spreadsheet that I track everything in. So the first thing that happened back on August 2nd, the most significant thing was if we come over here, these columns, these columns right here. One of the things that I track that's super important is the number of stocks making new highs and new lows. If you notice, all back here, the number of stocks making new highs are outpacing the stocks making new lows. Then on August 2nd, it shifted. New lows began to outpace new highs. That's the first thing. Second thing, scroll over on the sheet a little bit more. Something else that I track is the quality of the trades. At this point, there was only one B level trade, and most other trades were C level trades. That's not good. Though I'm only interested in taking high quality setups. If there's no high quality setups, then I'm not interested in participating in that kind of environment. And the last thing on this day is the trade ideas. I track all of my trade ideas from the weekend and as they progress throughout the week. The weekend started with 44 trade ideas on it. You see how it started to deteriorate from it was doing well at 89, then it dropped significantly to 68%. By Wednesday, it was down to 41% of the ideas being at profit. That is minuscule. So, seeing that major drop off in trade ideas that are working is something else that clued me into, hey, the condition of the market is changing. Let's see. Uh, Comment from Alberto over here on YouTube. Personally, he tracks the McClellan oscillators, and those provide good clues. Yeah, you could use anything that you want that is going to help you in this regard. Now, I would like to share with you a Venn diagram that I use to give my views or that helps share my philosophy on how the market is evolving. One other thing that I want to point out before I jump into that Venn diagram, I almost forgot this part about it. If we take a look at the major indexes, going back all this way, and if we jump out on the chart over here and just look at the indexes from, let's see, can I replay all this? I don't think so. Can only replay one chart at a time. But if we take a look at where these crosshairs are, going back to the 2nd of August, the indexes were starting to move sideways, largely still in uptrends on the daily time frames, in uptrends on weekly time frames, and in uptrends on monthly time frames. Something else that I track here on this spreadsheet. I track the trends so that way I could see how the trends evolve over time. And yes, back then on the 2nd, it was sideways and positive on the daily. On the weekly, it was predominantly in an uptrend. On the monthly, it was predominantly in an uptrend. And it wasn't until towards the end of that week that it started to shift. The weekly trend started to shift to sideways, and some of the dailies started to shift into confirmed downtrends. But let's get back to this other picture that I was going to share with you. So here's a picture. Drag this over here. Share this picture with you. This picture gives you a snapshot of how I view the big picture and what I look at and why. Allow me to explain this image here. The way that I look at market conditions and the way that I look at market mood is made up of the things in this Venn diagram. The big benefits to looking at the market in this particular fashion will be one, to filter out the noise. Anything that makes it into one of these three quadrants is the things that I'm going to look at. Anything that falls outside of it is noise. So, great way to filter out the noise. But the second thing is that it allows me to react a lot quicker to changing market conditions, and this doesn't take much time to do at all. This is the same process that I was using when I was trading part-time many years ago. So let's get into the different things that are included here, here, and here. General market conditions. What do I include in general market conditions? General market conditions are everything that I have in the spreadsheet to this point, or really a little bit further over to this point here. That's the general market condition. Whoa, what are those? I'm looking at trends on the major indexes across time frames, so monthly charts, weekly charts, daily charts. I'm looking at distribution days, and I'm looking at the number of stocks making new highs and new lows. Why am I interested in those particular things? I'm interested in those things for a few different reasons. First, looking at the major indexes tells me where the bigger picture is. Is the trends moving up, down, or sideways on daily timeframes, weekly timeframes, or monthly timeframes? Most stocks are going to follow the broader trend of the market. So I like to be aligned with the broader trend of the market. The broader trend does not lead the market, however. I was confused about that for in my earlier days, and most people tend to be confused in that way. They want to trade in alignment with the broader trends, but the broader trends are going to, by definition, lag the leading stocks. If your aim is to trade leading stocks, growth, momentum, those kinds of things. That's what I like to trade. Those will be leading the indexes, and the indexes will be lagging. Part of what I'm looking at is the general indexes. I look at the general indexes kind of like if you were to walk into a store, right? Pretend that you walk into a store, you walk into your local supermarket. If the shelves are fully stocked, the produce is fresh, it's a good time to buy. But if you walked into that same store and you find garbage all over the place, the shelves are barely empty, you find some moldy fruit on the stand, that's not the best time to buy. This is giving you insights into that. So I'm looking at the trends across time frames. I'm looking at distribution days. I'm looking at the number of stocks making new highs and new lows. The reason why I'm looking at distribution days, distribution is pointing towards institutional selling. What's institutional selling? It's when the big boys, your major hedge funds, mutual funds, pension funds of the world, when those guys start selling, they can't move in and out of the market like we can. So I track how much institutional selling there is in the market. So that way I can get clued into, okay, these guys are starting to dump shares. If we come down a little bit onto this column over here, and we take a look at where distribution is right now, you can see how it started to pick up, right? This is distribution over the last 25 days. You can see how it started to pick up from 3, 4, 5, 6 days. Then one day fell off the count back here. Then we got another one, another couple in here, 7, 8 days. In the last 10 days, there's been a lot of selling, a lot of distribution. There's 5 in the last 10 days on the S&P, 6 in the last 10 days on the Dow. That is pretty heavy duty selling. It's something that we should be aware of. Next up is the number of stocks making new highs and new lows. Why is that important? If you think about it logically, how is the major indexes going to continue to make new highs if the stocks within them are not continuously making new highs? Same thing on the new low side. If you start to see the number of new lows pick up, how is the index going to be continue to rise? The the fact is that it's not. And I've gone back in time and I've looked at every uptrend on the Nasdaq. I've got the Nasdaq listed out right here. So I've gone back and I've looked at every single major uptrend, and you don't have major uptrends like this without new highs accompanying it. You see all that green there? That's all stocks making new highs. When it shifts to red, that's when you start to have new lows outpacing, and that's when you start to get weakness. It's true for any period. This back here is 21. Then you go back to any of these, right? Take a look at this back here, right? The new lows start to outpace, and you get this. That's one of the reasons why it's so important to track the number of stocks making new highs and new lows, and that's why that's something that I do every single day. We just spoke about general market conditions. Those are the things that I look at for general market conditions. Doing everything that I just outlined for you takes me maybe about 2 minutes a day. If that, it's very, very easy to do. It's a very simple process, and it's one of the reasons why I've why I started doing this when I was trading part time. Back then, I didn't have loads of time. I would do all this stuff at night on the weekends, and it worked, right? That's another important thing too. It's important for whatever it is that you're going to do to actually work. Alberto, question. Uh, Asking, is the spreadsheet linked to live data? No, it's not. I'm filling in all the data on this spreadsheet at the end of the day. So at the end of the day, I'll go in, I'll take a look at, well, where did the S&P close? Where did the Nasdaq close? I'll take a look at my charts here in TradingView. That's the charting service that I prefer to use. Feel free to use any charting service that you want. I happen to like this one. I'll take a look at the major indexes across time frames and see, well, where did they finish? And then after that, I will log where they finished in the spreadsheet. And that process takes 2 minutes, not much time at all. Same thing with distribution days. I've got a script in TradingView that is counting up distribution days for me. So I have that. And the new highs and new lows indicator, I have that. And I'm just tracking it in the spreadsheet. So next up, next thing that I'm looking at is this here, your system. Your system performance is very, very important. The reason why your system performance is important is because if your system is not working, then you shouldn't be trading it, right? You only want to be trading your system when it is working. How can you tell when your system is working or when it's not working? Let me show you. The way that I go about telling if my system is working or not working is looking at these things here, right? The trade grades, the focus list, stocks in the neighborhood, the win rate of the trade ideas. So, what are these things? Well, I have a way to find setups, right? I have setups that are defined. I know precisely what I'm looking for, how it should look, what makes something quality, what makes something garbage. And if I'm finding loads of high quality stocks, then to continue with the analogy that we used earlier, go to the supermarket. If there's loads of great merchandise on the shelves, then that's a good time to buy. If there's garbage on the shelves, then it's not a great time to buy. So if I have a way to determine that in as far as stocks go, and I walk into the stock market and I find B and C level setups, then that's not a great time to buy, is it? I don't want to buy B and C level setups. I want A level setups. So when I find A level setups, like they were being presented. There were many A-level setups being presented in June, in July. That's a great time to buy. So that was something that encouraged me that, hey, system-wise, it's a great time to be involved in the market. But I don't want to just go based off of that. I want to go based off of how many stocks are imminently ready to buy. That's my focus list. How many stocks are getting close? That's in the neighborhood. And the trade ideas, I'll run screens on the weekend and I will track whatever trade ideas I come up with on a Saturday. Uh, for the week, I will track those ideas and I'll see how the market treats those ideas. If the market's treating those ideas well, then that's something that's telling me, hey, the market is favoring your style right now. Time to buy. Awesome. It would be like you could close your eyes, reach into a bag, and pull out a winner, like it was back here, right? 90%, 88%, 86% by the end of the week. You could close your eyes and pick out a winning trade, and it would be easy. Versus where we're at right now, fewer stocks made the list, and only 15% of them are at a gain. So that's telling me that it's very difficult to pick a winner. That's not the kind of environment that I want to participate in, right? So it's not just knowing the system, it's knowing how to respond when the system is working or when you're not getting a lot of traction. All the stuff is part of the system. I say system working, system not working. The system is your system should always be working. It's just a matter of it's really telling you when you should be participating, when you should not be participating. Next, personal performance. So, personal performance matters quite a bit. Personal performance, if you are adhering to your set of rules, whatever your edge happens to be, then you should be trading the best of the best setups, the best stocks, the best opportunities at all times. If you're trading the best stocks and you're gaining traction, that's feedback from the market. That's telling you, hey, not only is your system working, but your best ideas are working. Here's money, and it's time for you to be scaling up. Conversely, when the opposite starts to happen and you're putting money in, you're not gaining traction, you're getting stopped out, that's also feedback. If you're not gaining traction on your best trades, then that's the market telling you that it's time to reel it in, pull back, and start trading smaller. That's what happened, and that's how I was trading back here, right? So I also track my open trades, right? So I started to scale up, had more winning trades on, started to scale out, and then by the ninth, I was out of my last trade. And here are some of my trades. Let's go to the closed trades. I'll scroll down to the bottom over here so we could look at the recent ones. This was the last trade that I had on GCT. I was away part of this week, so that could be part of the reason why I wasn't in anything this week. But that was the last one that I was in, and it was closed on August the 10th. So here are my recent trades, right? So you can see how this one was exited, that one's exited on the 10th, the 9th. This one was exited on the 3rd. Couple of small losers in there, right? SMCI, that was an add-on. I had another trade in SMCI back here. That one ran pretty well. But for the most part, losing trades are cut very small. 1%, almost 2%, almost 3%, 3.5, 4, 5.8. That's the largest loss that I've had in a while. 2.8. But most winners, the big point of the winners is you want to have your winners be bigger than your losers. This one here, 7.8, 7.5, 14, 12, another 14. Winners are also typically held far longer than losers. You want to be tracking all this. But as far as what we were talking about earlier with personal performance, if you're finding that you're gaining traction on trades, then that's something that is giving you feedback that it's a good time to be trading. Now, the way that I'll be using all of this stuff here is that right now I'm coming off several winners, right? Well, take a look at the spreadsheet again. I had three big winners in a row: 14, 12, and 14. And the losers were only 1, 2%. So I'm sitting on some fairly decent profits. I take a look at the other parts of the system, right? That's where the spreadsheet starts to come in. And if I take a look at the spreadsheet, where was the market move? Here it goes. Yeah, so if I'm taking a look at this and I see that, oh, there's only B and C level setups, that's not good. And I take a look at the general market conditions and it's in a downtrend, that's not good. Is that a time that I should be taking all the profits that I had and plowing them back into the market? Absolutely not. I want to wait for the high quality setups to show up. That is how you make consistent money in the market. That's how you not only make money, but you get to keep the money by being patient and waiting. You need to wait for the high quality setups to appear. So for right now, I'm sitting, I'm waiting, and if I need to wait another couple of weeks, If I need to wait another couple of months, so be it. I'm only going to trade the high quality setups when they appear. I'm only going to have a small amount of risk when those trades show up. And I'm always going to be looking for much higher upside. So let me see, what questions do you guys have? I see a question there from Alberto. Alberto's question is, just out of interest, what screener do you use? I use MarketSmith. MarketSmith is far and away the best stock screener that I've found. Um, I like using MarketSmith screeners for a couple of reasons. The first is because I can customize any kind of screen that I want. You might find that in other stock screeners. That's not the big part, but one of the big parts that they do that I haven't found anywhere else is one, the way that they lay out the data, and two, that you could run screens over other lists. So you could build utility screens. And MarketSmith is very good, especially if you trade growth stocks. Let's see. I see a question. I'm third. I'm just scrolling through uh, Instagram to see if there's anything related to what we just spoke about. We'll go over to trading targets uh, after. See a bunch of questions coming in uh, from YouTube. That's very nice. All right, we'll go to YouTube. YouTube's questions are better. Um, I'm third. In the last session about trading targets, if you get the stock that goes to breakout and goes up 20% and hits your target, you sell into strength or you just hold the position and see how the stock behaves. Great, great question. I'm just going to have a quick sip of coffee first. I never sell anything all at once, or I should say that I very rarely sell anything all at once. There's a couple of scenarios where I would, but in most cases, I will scale out of positions. I'm moving incrementally when I scale. So the first place that I will look to sell is when I've made about one times my risk. I'll take a little tiny bit off, like a token amount, just to get me into the selling mood when I've made one times my risk. Either one times my risk or 5%. If I'm risking less than 5%, I'll still take off at 5%. So some trades I'm only risking 1%. I'm still going to take off a little bit at 5%. Next, I'll take off about half the trade, anywhere between, let's say, a range of 8 to 12%, the average being 10%. Why that range? That's how my average gains have fluctuated. Particularly this year. But I would go as far to say overall they range in that depending on the general market condition. So when conditions are working, then you start to see stocks moving further. When I'm observing that, and that's something else that I'm tracking in my trading journal in that spreadsheet that we saw earlier, I want to give those opportunities more room to run, right? Because stocks that start working, that start trending, tend to start doing that in a group. So I'm paying attention to that. The moment that I start to see that stocks are running further, I start letting the leash out a bit more. When I see that they stop working, I'm tightening things up. So that's how we have that. I want to be out of about half the trade at that point. Then the last part of it, right? Because how am I going to know if the stock is going to continue trending? I need to have a piece on. I'm going to keep half to allow half to continue running beyond that. As that part continues to run, Then I'm looking at the bigger picture of my most recent trades. How high have they gone? I want to start scaling out. I don't want to be greedy. I want to scale out of the a quarter, right? Or half of the half, and then allow that last half to just keep on running for as far as it's going to run until I start to get danger signals. And we've spoken about danger signals before. We could review danger signals again on another live stream if you want to do a show on that. But that's basically, in a nutshell, how I go about scaling out of trades. Question from Naveed. In your book, you mentioned danger signals. Oh, perfect question. All open game, mid game. How do you determine which is which? Great question, Naveed. So, how do I determine which is which? I do that, and I'll share my screen again, bring up the spreadsheet. I do that on right over here. So I have my danger signals listed out over here, and I have different rules for my danger signals, right? Of how and what I'm going to operate. So in the beginning, and I'm going to uh, sell if I see six or more danger signals. In the middle, I'm going to aggressively tighten my stops if I see seven or more. And in the end game, I'm going to sell if I see nine or more danger signals. Okay, so how do I know which is which? The way that I know how which is which is if the if I'm if my stop has moved to break even or until my stop is at break even, that is what I'm considering the beginning part of the game. And my first objective in any trade is to get my initial risk off the table. The closer, the smaller the risk that I'm taking throughout the trade, the better. The reason why is because the stocks that are going to work the best will typically break out and go. You'll have a few of them that take a little while to get out of the gate and then go, but for the most part, your best winners are going to be out of the gate and running quickly. So the ones that are going to be the big winners, I don't want them to have to do a ton of heavy lifting for the losers. So, and the ones that lose typically lose pretty quickly too. They typically lose within the first 5 days or so. So, I want to be cutting those losers quickly, and I want to be getting the stops on those up quicker. So rather than taking a full, let's say that I started out with a 5% stop loss. The quicker that I'm able to get that stop loss to, say, 3%, 2.5%, 1%, or to break even, the less work the big winners will have to do for that. So just to really drive it home, one of the last trades that I had on GCT made about 15%. If if the trade right before it broke even, then that's 15% in my pocket. If the trade right before it was a 5% loser, then I only have 10% in my pocket. That's the reason why you want to have your losses be as small as possible. So that way your winners don't have to do as much heavy lifting for the losers. So to go back to the question, the open game is uh, any point before the stop is at break even. The mid game is between break even and getting my average gain. And again, the average gain is between 8 and 12%. So we'll just say the average is 10. And then the end game is everything beyond that point. And that's why the amount of danger signals that I'm looking at and how I'm going to respond changes because as the stock continues to work, it's earned the right to have more danger signals. In the beginning, it hasn't earned that right yet. So I want to be out very quickly. All right, let's see. Well, what other questions have come in here? I'm third says, thanks a lot. I've learned a lot from your book and from your live. I'm a big fan from Thailand. I try to adopt your trading strategy and trade it in the Thailand stock market. I think that that is awesome. And I also want to say too, I was speaking to Wiley, my publisher, the other day. We need more reviews on Amazon, on Barnes and Noble, on Books a Million, on all these places. So if you have the book and you've enjoyed the book, go to Amazon, go to Barnes and Noble, go to these places and leave a review. I also heard that you don't need to have purchased the book from that distributor to leave a review. So you could go to Barnes and Noble and leave a review on the book. You've read it, you have something nice to say, leave it there. That would be very helpful to, of course, to me and to for the book and to get the book into the hands of more people. So if you read the book, you enjoyed the book, you listened to the book is on Audible as well. Please go leave reviews. That would be extraordinarily helpful. Um, I'll take one or two more questions. I'm just going to scroll through Instagram real quick and see if any questions came in on Instagram. Don't want to neglect you guys over here. Looks like a lot of people are hopping in, hopping out. Okay. Last question is for you, Naveed. Your question: how do you use the anchored VWAP? I'll show you how I use the anchored VWAP. The way that I like to use the anchored VWAP, and I'll pull up a trade here. Let's pull up a stock, SMCI. That was one of the big winners here. Actually, there's so I annotate my charts so much that I think that this is kind of noisy for you guys. So why don't I bring up a different one here? Yeah, well, let's use this one, right? LINC, Lincoln Electronic That Lincoln Educational Services. This was one that I had on the radar yesterday. I had it as a B level setup. Didn't so because it's a B level, didn't want to take this trade. But if I were to use anchored VWAP on this, what I would do is take the anchored VWAP and first I have to find the anchored VWAP. Where is it? I thought that it was in here. Yeah, there it is. The first spot that I want to attach the anchored VWAP to is earnings, right? The most recent earnings. So I'll put it there and I'll see how the anchored VWAP falls. So it falls right in the middle of the price action over here. So that tells me a couple of things. That tells me that if price were to break out, let's say price breaks out on Monday, right? It's possible that price breaks out today, but it's more likely that we see a breakout next week at this point, right? Well, we're halfway through Friday, and uh, much better chance that we'll see it happen on Monday if it happens at all. So let's say price breaks out on Monday. If price breaks out on Monday, then when it falls back, if it were to pull back, then it would need to take out the anchored VWAP from earnings. It would need to also take out the 10-day exponential moving average. What I'm talking about here is building confluences around stop areas. That's why I'm even interested in things like an anchored VWAP to see if it can potentially work as a support area. If price were to break out, you would see it work as support. Another spot, and let's see if we've got some other better examples in here. Yeah, let's use this one. Joe, ticker JOE. Here's two spots where you could use an anchored VWAP. You could use it from earnings, and it puts it right above over here. And then you could take an anchored VWAP, and I'll also like to put it at some of the higher levels of volume, right? So that was a very high volume day. I'll connect it there. And you see that this particular anchored VWAP is all the way down here. Now, for me, that's a potential support area that's a million miles away. I'm not interested in that, and I want to keep my charts relatively clean, so I'll take that one off. This one here from earnings is useful. And it's also, in this instance, a reason for me not to take the trade. The reason why I wouldn't take this trade, well, one, this deteriorated long before price ever broke out. Instead of breaking out, it broke down. That's the second best thing that a trade could do for us. Let us know that it's a loser before it triggers an entry. But in this case, if it would have broken out, right, it would have broken out here, would have gotten above resistance, and it would have needed to take out a couple of the short-term moving averages. But then right in its face is the anchored VWAP. And when I see something like that, I don't want to stop after it breaks out to immediately find another spot of resistance. So in that case, that was a great reason to not take this trade. And so that's why yesterday I only saw B-level trades and C-level trades. And so that is it for today. So again, I want to thank you all for being here. If you've read the book, I'd love to hear about it. Let me know, and make sure that you leave a review on Amazon, Barnes & Noble, Books A Million, all these spots. Help us get the word out on the book, especially if you've enjoyed it. Have a great rest of your day. Have a great weekend, and I will see you back here on Monday. Take care, everybody. Much love. Peace out.